Looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. Our first question is from Michael. He says, my dad had preferred stocks and he always seemed to like them. How do I know which ones to buy? All right, Michael. Diving into preferred stocks is a smart move when looking for income in retirement, especially with reduced risk and volatility. Now, preferred stocks can indeed be a valuable asset class, but picking the right ones requires a bit of careful consideration. First, unlike mutual funds or ETFs, there aren't many preferred stock mutual funds available. This means investors typically need to select individual preferred stocks, which can deter some advisors who prefer the convenience of fund-based investing. So how do you know which preferred stock to buy? So let's break it down. Similar to bonds, preferred stocks have credit ratings assigned by agencies like Moody's or S&P. And these ratings assess the creditworthiness of the issuer, indicating the likelihood of timely payments of dividends. It's wise to filter your options based on these credit ratings to ensure you're considering stocks that align with your risk tolerance. Next, conduct a thorough financial analysis of the issuing company. Just as you would with bonds, examine the company's financial health, its revenue streams, debt levels, and overall stability. This analysis helps gauge the issuer's ability to continue paying preferred dividends reliably. One significant consideration with preferred stocks is their callability feature. This means issuers can redeem these stocks at a predetermined price and time. Especially if interest rates decline, this could potentially lead to losing out on the higher dividends you were counting on. To mitigate this risk, look for preferred stocks that are non-callable or have longer call protection periods. This strategy allows you to lock in your rate for a more extended period, providing greater income predictability. Additionally, it's important to note that a substantial portion of preferred stocks are issued by financial institutions. Now, while these stocks can offer attractive yields, they also concentrate risk within the financial sector. So to diversify away from this sector concentration, consider looking for preferred stocks issued by companies outside the financial industry. However, if you do invest in financials, prioritize those issued by large, stable institutions commonly perceived as too big to fail, right? These institutions typically have robust balance sheets and resilience, which can enhance the safety of your preferred stock investments, as was evident during the 2008 financial crisis. In conclusion, picking preferred stocks involves a blend of credit analysis, financial scrutiny, and strategic thinking around callability and sector diversification. Now, while they can provide attractive income streams, especially in today's yield environment, it's crucial to conduct thorough research or consult with a financial advisor who specializes in income-focused strategies. By focusing on these factors, you can make informed decisions that align with your retirement income goals while managing risk effectively. So I hope this breakdown gives you clarity on how to approach preferred stocks as part of your retirement income strategy. Great question. If you would like to send in your question, you can do so. You can email that question to poollocke@poolelocke.com. Our second question from Matthew. How can I hedge against inflation inside my retirement portfolio? What should I invest in? All right, Matthew. Addressing inflation within your retirement portfolio, while aiming for reduced risk and reduced volatility is critical. It's a critical consideration, especially in today's economic landscape. So let's dive deeper into your question about hedging against high inflation. First, hedging against inflation while locking in today's higher rates can be quite challenging, as kind of these two objectives often conflict. However, there are strategic approaches you can consider based on your specific retirement income needs and risk tolerances. So one effective strategy, as I've mentioned in other videos, is to build an organic inflation hedge through your investment income. So suppose you're fortunate enough to generate a portfolio yield of, say, 6% through interest and dividends. If your immediate income needs are only 3%, you can reinvest the remaining 3% back into your portfolio. This reinvestment not only helps your investments grow over time, but also serves as a natural buffer against inflation. This approach, often referred to as compounding or reinvestment, allows you to potentially grow your income stream over the long run. Now, if you require all of your retirement income up front or prefer not to reinvest, you'll likely need to explore other investment avenues that offer inflation protection. Now, one common strategy is investing in high dividend stocks. These stocks typically belong to companies with a stable financial position and a history of distributing higher than average dividends. So some high dividend stock strategies can yield upwards of 4%, providing a steady income stream that can potentially keep pace with inflation. Another avenue to consider is investing in business development companies, BDCs, and real estate investment trusts, REITs. BDCs, similar to bonds, provide loans to businesses, often with variable interest rates. In inflationary periods, those rates can adjust upwards, thus increasing the income passed on to investors. Similarly, REITs invest in real estate properties and distribute rental income to shareholders. Inflation tends to kind of drive rental prices higher, potentially boosting your income from REIT investments. However, it's crucial to note that both BDCs and REITs come with their own set of risks, particularly related to economic cycles and interest rate fluctuations. Therefore, thorough research or consideration with a financial advisor specializing in income-focused strategies is advisable to ensure these investments align with your overall retirement goals and risk factors. Wrapping it up, while achieving both high income and inflation protection simultaneously is challenging, it's not impossible. Depending on your retirement income needs and investment horizon, you may choose to reinvest dividends for organic growth or explore high dividend stocks, BDCs, REITs for potential inflation adjusted income. So by understanding these dynamics and making informed decisions, you can navigate the complexities of retirement investing with greater confidence. Great questions today. If you'd like to send in your question, you can do so. Email that question to poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source, and I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the